The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Good morning, everybody. You're watching Squawk Box this Tuesday morning, and these are your headlines. The Dow diverges, hitting a fresh record high, whilst chip weakness sends the S&P 500 and the Nasdaq into the red. The former Fed official Robert Kaplan outlines to CNBC the rate options open to the U.S. Central Bank.
If that job report is weak, they'll go 50. If it's stronger than people are expecting, which is a possibility, then I think they'll go 25.
Chinese industrial profits grow at their fastest pace in 5 months, spurred on by the high-tech manufacturing sector.
The world's largest miner, BHP, beats expectations and refocuses on copper after its failed bid for Anglo American. CEO Mike Henry tells CNBC Chinese government support could also be a boon for steel.
We expect that we could see a turnaround in the property sector in the year ahead. In terms of the overall impact on steel, we should keep in mind that steel is still running, and we're still calling for over 1 billion tons of steel production in the year ahead.
French President Emmanuel Macron rules out forming a government with the leftist New Popular Front alliance as the deadlock from July's snap parliamentary election drags on. And media mogul Edgar Bronfman Jr. walks away from his bid to buy Paramount, paving the way for Skydance to complete its deal for the company. Very interesting how a market can play out from one day to the next, right? Seeing significant gains to close out then on Friday, following, of course, that speech by Fed Chair Jerome Powell with regards to interest rates, the time being now ultimately. And then you see some negative numbers then come out the following week then. And yes, Nvidia does perhaps become one of those that become interesting for this market picture because overall we saw that draw down. But there was still records in play in yesterday's market, and that was the Dow Jones Industrial. That's a record number there at 41,240. And while it did hit an intraday record high and perhaps dropped down just a little bit, still managed to find 65 points and hit an all-time record close there. The Nasdaq Composite having gone down then following on from the day before's or the previous session's uptick of more than 1%. Investors definitely eager to see what earnings picture Nvidia pretty much paints, particularly for the semiconductors and demand in that AI chip sector. That will be one to look out for then for tomorrow. We'll of course focus in on that. And in extended trading, Apple, that share price then dipped down just a little bit. It does follow on then from the announcement that the CFO, Luca Maestri, will indeed be stepping down from that role at the end of the year. An interesting story that we'll unpack for you as well throughout the day. I made note of those chip stocks then being very important as we lead up to Nvidia's numbers, of course. Then it's really going to be more about that beat and the demand picture following on then from those Nvidia numbers. Is it looking like the demand is still intact? And how much impact is actually still at play with regards to the question marks around Blackwell and its production, as well as the supply chain then following on from the chip sector overall. So this is what you saw then off the back of some of the weakness then coming out of Nvidia, 2.24% there. And you saw AMD also take down 3.2% or go down by that much. Micron also losing nearly 4% in yesterday's trade with Applied Materials following suit. On the treasuries front then, you saw U.S. Treasury yields actually dipped then, particularly new data revealing a slowdown in business spending as well then as investors remaining cautious after last Friday's steep drop then, of course, in those yields as well. So you're seeing the 10-year note at 3.82. Yesterday, we had even seen it at 3.77. So perhaps a slight uptick then today coming back off those yields. The 10-year Treasury note had even fallen 2 bips to 3.78 actually in yesterday's numbers, but you are seeing a retracing of that. The 2-year still below that 4% mark. Quick look at the dollar crosses here, around the flat line for some of these then as well. Lingering concerns over tensions in the Middle East will certainly be at play here, but now back below or rather just above the 144 mark, which you had seen it at yesterday then, and now headed towards what it looks like then, that 145 picture for dollar yen, as we're seeing it there, giving up yesterday's gains, which saw it, of course, sit at around 143.45. That was a 3-week high for the yen in yesterday's picture. Euro sterling, you are seeing 131.96, nearly that 132 mark, and 111 then for euro dollar, Steve.
Thanks very much. I find something we've already done on this show quite incredible, and I'll come to that with David Roche in a few moments' time. Quite incredible about one piece of data and the power it may well have. I'll get to that. San Francisco Fed President Mary Daly says she believes it's time to begin cutting rates. In an interview with Bloomberg, Daly said the Fed has been ready to adjust for several months, but that now, quote, the time to adjust policy is upon us. When asked about the size of the Fed's September move, Daly suggested that if incoming data supports her expectation of gradual slowing of inflation and steady labour market growth, a 25 basis point move would be appropriate. But that if the Fed sees signs of labour market weakness, it would be appropriate to move more aggressively. Long sentence. Let us move on. Traders have reduced their bets on a bumper 50 basis point move, now expecting a 28.5% chance. Gosh, that's specific, isn't it? 28.5% chance according to LSEG data versus a roughly 35% probability after Powell's Jackson Hole speech. Markets have priced in 100 basis points of easing by the end of the year. So we've been speaking to a lot of top economists about the central bank's next move, but isn't this absolutely fascinating? Those Kaplan comments we heard in the headlines, he nailed it down to one piece of data. Well, let's listen in to El Arian and Kaplan and others.
The view in the marketplace is that this is a single mandate Fed, that the only thing the Fed is worried about is higher unemployment. And that's why you've had this very aggressive pricing of cuts validated. If that occurs, it's because something went wrong in the economy.
If that job report is weak, they'll go 50. If it's stronger than people are expecting, which is a possibility, then I think they'll go 25. And they'll do that in order to move more deliberately and be able to control the pace.
Our assumption is that the August employment report will look better than the July report. Maybe some of those temporary layoffs in July come back so that the unemployment rate comes down. And job growth, we think, is trending closer to 150 than the 114 we saw last month. If that's right, then I feel pretty confident that the FOMC will go ahead with a 25 basis point cut. They're not thinking in terms of 50 just yet. If I'm wrong and the August employment report is worse than we think, then I think a 50 basis point cut would be likely.
I'm absolutely staggered. Roche has been around as long as I have, actually. David Roche, who is the president of the newly minted quantum strategy. David, we've done over 70 odd years in these blooming markets between us, obsessing over payroll data and other things as well. Really? We're down to one piece of data, whether it's 50 or 25. I find that quite staggering because in my experience, having been in this market since 1988, it's a random number generator. We can forget about the PCE, the CPI, the initial jobless claims, the jolts, you name it, that we obsess about. It's all about whether this random number generator is hot or cool.
Well, I'm afraid it is. Now, the reality is that the Fed, like everybody, has got an inbuilt prejudice, which is unemployment. But to actually reduce what is a very variable and volatile decline in inflation, to actually take it out of the picture, which is pretty well what has been occurring, is, I think, quite another matter. I find it quite surprising, but we're not surprised by that. We've seen that before, Steve, many, many times in our career. Then, of course, you have to say, what do you think? And you add the sound of my clucking to all the other birds in the farmyard clucking. And I think the US economy is amazingly strong. I think the job figure was a momentary panic, which is fading. And I think it would be completely fruitcake stuff to start cutting rates by 50 basis points, which is a signal that things are really bad when they are not really bad. So I don't know what we're going to get, because I think it does completely depend on the data coming in increasingly on one single topic, I can only tell you what I think makes common sense.
I'm with you, David, and I think you've hit many points there. But the signalling from going 50 in one go, that is like, oh crikey, instead of being in control of this situation, which we know central banks aren't quite as much in control as they love to believe they are, the signalling would be absolutely scary for some in the market and could create some of the volatility they're trying to avoid in their dual mandate. But the point I want to make as well is he has it in his Powell has it in his power to actually signal a dovish cut if he wants, i.e. the market could already price in 50 basis points over 2 meetings rather than 50 in one if it wants, because the market, as we all know, the price of money isn't priced off the base rate or the actual Fed funds rate, it's priced off the futures curve as well. He can do that if he wants.
Yes, he can do that, but I would stress, like you, that there is no need. The US economy compared to, let's say, Japan or compared to Europe is incredibly strong structurally. Not only cyclically, and there is no need to produce panic measures which will produce panic. And that's the end of it, frankly. Now, what they actually do is another matter, but I think the danger is that they create the panic they wish to avoid.
Yeah, so David, I mean, was Jackson Hole perhaps the closest we had gotten then from Powell pretty much declaring victory on inflation? I mean, I know he didn't put out those words, but when you compare it to the rhetoric out of Andrew Bailey and perhaps even out of the ECB, was that the closest we've gotten from him?
This was a great exercise in exoneration of oneself. Actually, more than half of the speech was about how the Fed had been so clever and so good. The inflation had been caused by that extraordinary accident, we are told, between commodity prices and overstimulus, obviously by the fiscal authorities, of the economy. And the Fed, like a well-trained pilot, negotiated through this. And thanks to the policy, monetary policy, they managed to bring down expectations of inflation, which therefore resulted in good inflation, lower inflation, which means that the Fed actually will solve the problem in an immaculate kind of manner. And I think that is very typical of central bankers, in which they take themselves out of the equation of having caused inflation and been a part of causing inflation through excess quantitative easing, excess money printing. And they say, oh, that wasn't us at all. We're perfect. Actually, more than half the speech was self-congratulation and self-exoneration, which I have the gravest doubts about. But then, of course, I'm not an academic providing the pillars of support for such pleasing theses at Jackson Hole.
Very interesting. I wonder, though, from you, what do you think drives markets more now? Is it going to be Fed rhetoric, that economic data, or the curious case of NVIDIA that comes out then tomorrow? What drives this market higher?
Oh, I think the NVIDIA thing will be the immediate impact, because if you actually look at markets, the immediate concern at the top of the pyramid is what happens to AI, what happens to tech, because it is such a big part of not only the pyramid of economic expectations that AI will save us all from falling productivity and demographics. It is similarly the idea that it is so important to markets. So you have expectations about AI in the economy, which is a pyramid, and in the markets, which are a pyramid. And then below that, you have the barbell of unemployment or labor markets versus inflation. And quite frankly, we have seen that if it tips either way a little bit too much on one single point of data, either growth concerns or inflation concerns can upset this market almost equally. And then at the bottom of the pyramid, there are geopolitics, where things can hardly be seen to be going terribly well, but markets don't care, because there is not an economic cost that they can trace easily within their limited intellectual capacity.
Yeah, I thought you were talking about me there, my limited intellectual capacity, David. I think you might have been. But in terms of other topics out there, like I've got a choice of two. I can talk to you about oil, but I actually really want to talk to you about China as well, because I've seen two separate pieces of information in the last hour or so, which actually make me think that there is a wider problem that is just being ignored, swept under the carpet, glossed over, and this is broader Chinese economic growth. Is there any? Because I look at the BHP warning on uneven recovery in China. Well, that says to me potentially there isn't even a recovery going on. And B, we've seen news out of Temu as well, which basically says the consumer is saying, nah, we're not going to buy so much stuff anymore as well. So I just kind of wanted a broad brush on where you thought we were at, David, on China at the moment.
Well, there has really been no action that addresses the problems of structural failings, whether it is debt, whether it's state-owned enterprises, whether it's local enterprises, regional government debt, or in fact, the property market. So you have all of these things building up, and you have a macro result of that, which is there is too much supply capacity and too little demand. Now, the supply capacity was previously bought by you as exports, and China exported its way to growth and out of poverty, of course. But now they have to grow themselves domestically. And the problem is they are missing the one thing which you can really never measure in economics, and that is confidence. The good burgers are not buying flats. They're not buying things in any greater amount. We've seen rather disappointing even internet sales. So essentially, China it has to completely go through a restructuring of its economy, and it's not doing it because it would politically be necessary to acknowledge that the past has been a series of huge mistakes. None of the policies have worked. That politically is a question mark over the sagacity, the foresight, and the legitimacy of the party. Now, if you think they're going to go there, then you really have expectations, which I most certainly do not. That's my China picture.
I mean, David, that paints a pretty bleak one then out of China. That means ultimately that around 5% figure of growth in the short term might be achievable, but long term feels a long way away.
It's always achievable because you can make it up as you go along. And nobody can measure GDP accurately anyway, and particularly not in a country as vast, as diversified, and with such, may I say, faulty methods of gathering statistics like in China, where in many cases, when you see a problem in the economy, you stop publishing the statistics, such as youth unemployment, and then you reinvent them. So I'm afraid I say I don't believe the 5% and I don't believe the 4%. I think we actually have no growth in China. And I would suspect that while it's not collapsing, it is rather like watching floating debris in a rather stagnant pond. It's not going anywhere. And that situation, of course, given youth unemployment and everything else, is actually not static. It is increasing in danger, both economic and political.
Yeah, that's going to be an interesting pond to kind of fish into as well at this stage. David, appreciate the time, though, this morning. Thank you so much for joining us. David Roche, the president then of Quantum Strategy, joining us then as we unpack market picture right now. Coming up on the show, though, BHP shares trading higher as the Australian miner tops forecasts following its failed Anglo bid. We'll bring you the numbers next. Plus, France confirms the arrest of Telegram CEO Pavel Durov. We'll have a full breakdown of what we know so far later this hour. And we'll get the latest then on the EV market as Canada imposes fresh tariffs on Chinese vehicles. We'll speak to Johnson Wan, the head of APAC Industrials, Mobility, New Energy and Commodities Research at Jefferies. That's coming up at 9:30 CET.
CNBC Connect is back in Bangkok, Thailand. Join the world's top entrepreneurs and C-suite executives for an invite-only leadership retreat. On the agenda, powering innovation and growth in Asia. Is AI transforming industries and creating opportunities? And get insights on building sustainable and resilient businesses. Be part of Managing Asia Live. Network and join an interactive brainstorm session. CNBC Connect, powering innovation and growth in Asia on September 4. Register now.
Now, Canada has announced that it will impose a 100% tariff on Chinese electric vehicles following the lead of the United States and the EU. Our Prime Minister Justin Trudeau also announced a 25% tariff on steel and aluminium imported from China. Now, shares in Tesla closed down more than 3%, with the Canadian government confirming that the duties will apply to all EVs exported from China, including Teslas. Now, the Canadian Prime Minister said the measures aimed at tackling China's unfair advantage in the global marketplace.
We are transforming Canada's automotive sector to be a global leader in building the vehicles of tomorrow. But actors like China have chosen to give themselves an unfair advantage in the global marketplace, compromising the security of our critical industries and displacing dedicated Canadian autos and metal workers.
Industrial profit growth in China picked up pace in July, up 4.1% on the year. This was boosted by high-tech manufacturing, which grew nearly 13%. The data comes as a boost to authorities, with sluggish domestic demand still weighing on the world's second largest economy as it struggles to regain ground after the pandemic. And BHP shares are higher. That's after the world's biggest miner beat annual underlying profit expectations, coming in at $13.6 billion. However, net profit did decline almost 40% due to one-off charges related to the company's write-down of the values of its nickel operations. BHP said it will now focus on growing its copper business after it walked away from its $49 billion bid to buy rival Anglo American earlier this year. Now, CEO Mike Henry told CNBC he was optimistic the company could overcome some external market volatility.
The underlying business, both operational and financially, is running really well. We set a number of production records across the business, both in iron ore and copper. Specifically in our iron ore business, second year running with record production, and we've beat inflation in terms of underlying cost increase of up only by 3% in an environment where inflation is running probably about 4% externally. And importantly, we stretched our lead in that business, and that's the flagship business for BHP. So underlying operations going well, financially in really good shape. Externally, of course, there's a bit of market volatility out there, specifically in respect of China, steel demand under a little bit of pressure from the property sector, but other sectors performing well. And our business is continuing to run well and certainly set up to be able to deal with the external volatility.
Now, Henry also outlined his expectations for China, in particular, the country's property sector.
We're seeing uneven growth. And I know that the property sector, because of its impact on steel and iron ore, gets a lot of focus, at least in respect of our sector. But it only makes up about 20% of steel demand. And there's a lot of other sectors in China that contribute to steel demand that are growing quite healthily. And that includes infrastructure, shipping, automobiles, and so on. Now, the weak point is property, where we've seen both sales and new starts running at levels substantially below where they were historically. Having said that, the government has enacted policies recently that are meant to support the property sector, and that includes a government program to acquire some of the excess inventory, and secondly, relaxation of some of the constraints on purchasing in China. So we expect that we could see a turnaround in the property sector in the year ahead.
Now, we will have more on BHP earnings and the wider mining sector with Marina Calero, the Associate VP for Mining and Metals at RBC. Tune into that interview at 8:30 CET.
So there's a 43-page BHP announcement, and I'm just listening to what Mr. Henry had to say there. Look, I mean, are we calling this how it is? He's saying it's an uneven recovery. It's the same comments that's in the statement here as well. But what does uneven recovery, does it mean there's no recovery in some parts? Does it mean there are declines in some parts as well? I cannot believe they are seeing growth in that property sector. And I saw him there on that quote as well, again, diminishing the importance of that property sector when actually, when it was going full guns blazing, they were expounding on the joys of having such exposure to the property sector as well. So for my problem, though, for this company and for the miners in particular, and I was looking at the share price a little bit earlier on, and we got it on the screen already, there you go. 12 months down 3.6%, year to date down 18% for BHP, which is in common with the rest of the sector, is you've got two thematics here which have been the great drivers for this company over the century. One is China growth, and two, everyone's talking about the demand for copper, nickel, and other resources needed for the energy transition. Well, the energy transition, as far as I can see, is stumbling at best. You've only got to look at how some companies that previously wanted to invest vast quantities in it are now pulling back their shareholder motions and what have you. And indeed the oil majors as well. So you've got the new energy transition stumbling. You've got China stumbling, which begs the question, is this sector now fully pricing in all of this, or actually is there more to go? So let's just go into a little bit more detail on what the share price is actually trading. It's trading at 10 times forward. Huge discount to the S&P, huge discount to where it was trading at its peak as well. I'm not saying this is the time to buy this sector, but I think if we've got clarity on where we're at on China and new energy transition, then you can start making informed decisions on this one. But as far as I can see, what does uneven recovery mean in China? Does it mean there's no recovery? Does it mean actually parts of it are big negatives? Maybe we'd like to dig into that in a bit more detail.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.